Wall Street Wrap-Up is supported by Bamboolas, featuring live music and coming soon, tapas and wine upstairs. Bamboolas, the heartbeat of Frenchman Street.
This week on Wall Street Wrap-Up, the Federal Trade Commission is suing Amazon because of their Prime memberships. The FTC is saying it's easy to get in, but not as easy to get out. India's Prime Minister Modi is getting the red carpet treatment from the White House. And also tech CEOs wanting to wean themselves off of China's dependency. Plus, increasing their market to over 1 billion customers, it's hard to pass up. Saudi Arabia and OPEC cut an additional 500,000 barrels of oil a day as the summer begins and vacations driving season ramps up. So will this mean for summer vacations? We'll talk to Francisco Blanch, head of global commodities for the Bank of America, about gas prices and refilling the strategic petroleum reserves. Now that we're into hurricane season, are we dangerously low? I'm Andre Laborde. We've got these stories and more. It's Friday, and it's time for Wall Street Wrap-Up. Hi, welcome to Wall Street Wrap-Up. I'm Andre Laborde for this Friday, June 23rd. The Federal Trade Commission is suing Amazon, claiming the online giant used tricks to make consumers join Amazon Prime. And now, by the end of last year, there were approximately 331 million people in the U.S. population, and of which there were 168 million Amazon Prime members, which means there's just over 1/2 of the U.S. population are Prime members. That also is more than half of all American families are Prime members. Well, the FTC is alleging that Amazon makes it difficult for you to then cancel your Prime membership or subscription. Amazon is firing back, saying the claims are both false on both the claims and the law. CNR research found that most Americans figured that they were spending $86 per month on those subscriptions that are automatically added on every month. It's such as Amazon Prime or gym memberships, cable billing, or magazine subscriptions. Sound familiar? But they also found that actually most American families, on average, underestimate how much they spend to $219 a month on add-on subscriptions. So, as a reminder, always check your credit card statements and checking account withdrawals every month. So with that thought, how did our money do this week? Well, it was a 4-day trading week with Monday's close due to the Juneteenth. All 3 stock indexes were down for the day and for the week as well. All sectors were negative today. Top stocks in the S&P were CarMax, Quest, and also sector laggards were utilities and tech and also real estate. Well, this week, the Dow Jones closed today at 33,728, which was down 1.6% for the week. And the S&P 500, they closed today at 4348, and that was down almost 1.4% for the week. And the Nasdaq, they closed today 13,492, which was down 1.4% for the week. Well, this week in Washington, India's Prime Minister Modi is being given the red carpet treatment with a state dinner at the White House that is attended by some of the biggest CEOs in technology. Now, this is aimed at trying to curb China's growing global influence. India is going to be getting from the United States Navy ships, engines from General Electric, and the purchasing of U.S. drones. Now, this is in the hopes of weaning India off Chinese equipment. Last week, we showed you how much weight a few selected stocks in the S&P 500 carried, and we got a lot of emails on this subject. Of the 500 stocks in the S&P, these top 7 stocks are the most weighted, which means their stock prices carry the remaining 493 stocks of the S&P. Now, here's some more food for thought. The S&P 500 year-to-date is up just under 14.5%, and those 7 stocks is the reason. Those 7 stocks account for 90% of the gain. Now, if you took those top stocks out of the S&P 500, the index would be up just over 5% for the whole year. OPEC, and especially Saudi Arabia, has cut an additional 500,000 barrels as of last month, and we're dangerously low in our SPR, the Strategic Petroleum Reserves, now that we've entered into hurricane season. So where's the price of gas going? Well, Francisco Blanch is Bank of America's head of global commodities, and he's here with us tonight. Hi, Francisco. Welcome to Wall Street Wrap-Up.
Thank you, Andre. It's a pleasure to be with you.
Oil has been around $70 a barrel. In fact, it's sometimes been dipping even lower. Is there a reason for this price per barrel going so much lower?
Well, there's a number of reasons, Andre. I think first of all, we get a pretty weak demand backdrop. Interest rates have gone up pretty sharply over the course of the last 14 months or so. Remember, the Fed only started hiking rates in March last year, but that's already had a knockdown effect on the U.S. and on the global economy. So we are seeing cyclical commodities actually turning negative. And in fact, we have a bit of a bear market, not just in oil. Diesel, gasoline, natural gas, coal, copper, it's all down year on year. We've ended up with a lot more oil coming into the global economy than we anticipated, thanks to the price cap mechanism pushed by the U.S. Treasury. That's enabled both Russian crude oil and petroleum products to hit the global markets, while reducing the amount of revenue available to a Russian government. So that's led to larger than expected supply availability.
We've had we've had economists on the show and also chief market strategists, and it seems like almost a consensus where so many of them are thinking that we're going to be going into a recession either toward the end of this year or the beginning of next year, of 2024. If that occurs, will commodities be rising?
They will not, Andre. I think if we go into a recession, depending on how rough of a recession we have, commodities will struggle. Now, that's not our baseline view necessarily. We think that the U.S. will see growth, maybe close to or around zero, maybe a little positive or negative. But then we are expecting the Chinese economy to improve over the course of the next 12 months, as they are reopening after a nearly 3-year lockdown due to COVID. We had much shorter lockdowns in the U.S. and Europe, but the Chinese have spent almost 3 years in lockdown, and now they're reopening. The U.S. is definitely on a path to slower growth. And also remember, Germany, one of the largest economies in the world, has spent the last 6 months in recession too. So we've had weak demand in Europe as well, not just in the U.S.
I mean, we just had Memorial Day, and now the summer has started. There was recently Scott Kirby, who is the CEO of United Airlines, on, and he was predicting a robust commercial air travel for this summer. Do you see that with people leaving their houses? You talked about COVID. Do you see that the price of gasoline and oil will be going up for the summer months?
I think it will be a bumper tourist season, summer of 2023 in the U.S. and in Europe. They're all telling me they have really strong bookings. It's true for travel, it's true for hospitality. We've also seen restaurants filling in pretty nicely. So I think we're going to get reasonable support. But then again, the cyclical side of things, where you're looking at things like plastics or things like diesel, which is very important in trucking, are really struggling. And I think just general global trade is down because we're buying less goods than we were in 2020 and 2021. We were all locked up at home buying stuff on Amazon on our phones. Now we've been out and about, and we're spending most of our money in services. So we have a very robust services industry, and that's reflecting also in weaker demand for some of these fuels. But I still think that demand for mobility is going up. It's just maybe not as strong because of the diesel component, just putting a lid on the petroleum complex.
Saudi Arabia said that they were cutting 1 million barrels of oil and that'll be going until the end of this year. And Russia, which is part of OPEC Plus, they're cutting, they said that they would be cutting 500,000 barrels. And do you think that OPEC is going to be cutting more oil when they meet in Vienna?
They cut production in September of last year a little bit. Then they cut production more deeply in October. And then they cut production pretty deeply at the beginning of April. And in my conversation with different OPEC members, my understanding we're trying to do is they're trying to prevent inventories from continuing to build as they have over the course of the last 6 months. And they are trying to be preemptive, but also proactive, making sure that inventories don't build to a level where prices will implode. Now, you mentioned Russia, you mentioned Saudi Arabia. Uh, these two countries are in very, very different position. And we think they'll cut again as they come into a Vienna meeting, or maybe it'll take another month to cut, but they'll have to cut again. We have it in our forward balances. The Russians, they say they're cutting, but there is something funny going on there with Russian supply.
Well, Russia is not under any specific guidelines of being able to accurately state how much oil that they actually ship out. So, to my understanding, that Saudi Arabia, Riyadh, is very upset with Russia because they are pushing out so much oil. Is there an animosity between Russia and Saudi Arabia?
Well, I mean, we've seen it in the past. Certainly, remember, Russia and Saudi Arabia have had oil price wars a couple times. Last time was in 2020. Now, I think it's, like I said, it's a different situation for Russia and Saudi Arabia. In 2020, the Russians didn't want to cut production into COVID. The Saudis did, and in the end, Saudis expanded production, hit actually their highest volumes ever as COVID ripped through the global economy, and ultimately that's how we ended up with negative oil prices in WTI, and Brent international benchmark went down to $10 a barrel. I think the issue with Russia, and again, this is the argument they're making. They're saying, well, we are actually experiencing weak demand at home. And by the way, we're not pushing oil through pipelines into Europe because of the sanctions. We're seeing more Russian oil in vessels because it's not going through pipelines, because it's not being consumed in the domestic market. I think there's a little bit of truth to that, but it doesn't take away the fact that it's not helping tighten global oil balances, because at the end of the day, what drives the price of oil is the marginal demand against the marginal supply. And today we have, at the margin, more supplies from Russia. If you end up in a situation where there's no Russian oil hitting the market, we could be at $200 a barrel or higher, right? And I think there's a lot of concern in Washington about a second round effect of inflation coming from big disruptions in Russian oil supplies, and I think they also figured out the basic economics that when you cut production aggressively, you can also end up with much higher prices, and effectively the net revenues to the Russian government could actually be going up even on lower oil volumes, which is what they try to prevent with the price cap. And I think it's worked. Generally, we're seeing lower oil prices, we're seeing more Russian supplies. And ultimately, it may not be helping Texas and Louisiana, but ultimately it's going to be helping the U.S. consumer, the global consumer, at $70 a barrel. It is a surprise that I think it's in essence much more conducive to a better economic outcome into the second half of 2023 and to 2024. I mean, you talked about recession, but if energy prices keep going down, and that will provide some cushion to the economy.
Because of the sanctions, the United States and other European countries have put Russian oil at a cap of $60 a barrel. So in theory, they're not allowed to sell their oil for over $60 a barrel, even though, as you were saying, where oil is going now at $70 a barrel, give or take. So, but oil is so fungible. So do you see that the oil that's being registered at $60 a barrel is really working?
Neither Europe nor the U.S. can control who Russia sells their oil to. Now, Russia can sell that oil directly to China, can sell it to India, or they can sell it to an intermediary, as we've seen, that may be based in the Middle East somewhere, or in an offshore location. So when it comes to taxing that oil, the Russian government doesn't have a big direct tax stake, which is ultimately the purpose of this tool, is to reduce the ability of the Russian government to raise taxes from oil sales. That is the purpose of it. And in that regard, it's effective. We have lower oil prices. And Russia has lower revenues. So we've achieved both bringing down inflation and reducing the ability of the Russian government to keep funding the war in Ukraine.
Whatever oil Russia wants to sell, China, and as you also mentioned, India, is ready recipients to being purchasers of this oil?
Oil from Russia, which used to go mostly to Europe, remember, 50% Russian oil sales used to go to Europe, are now mostly going to China and India, which are the top two importers of oil in the world. The Chinese economy is not really doing all that well, right? And I think part of it maybe when they reopened post, in November, said, we're gonna move away from zero COVID. I think people thought, well, they're going to come back roaring, right? And it hasn't quite been the case. China is the factory of the world, and also we've seen increased pressure from the U.S. to reduce dependency on trading with China over the course of the last few years, and the U.S. has been pressing very hard to relocate factories and manufacture goods away from China to closer to home, like a place like Mexico. Then there's another factor in China, which is demographics. Today, India is a bigger country than China, people-wise, and today Chinese population is shrinking, right? It's shrinking, and there's no way to fix it.
You have 9 members of OPEC, and some may agree with cuts, and some possibly may not. Do you think that after the meeting that there will be some countries of OPEC that will decide to not go along with these cuts and start putting out more oil? Because Saudi Arabia may be doing very well economically, but there are other members of the OPEC family that are not doing as well.
Yeah, Andre. I mean, this has always been OPEC's big challenge, trying to herd cats, if you like. Each OPEC member has a very different demographic profile, very different government spending needs. The Saudis are pretty determined to limit the downside risks on oil prices. The U.S. government itself could become a buyer of oil, and in fact, there's been indications that may be the case heading into the second half of the year.
With the SPR, the Strategic Petroleum Reserve, we are, to my understanding, about half of what we had prior to the Biden administration releasing quite a bit of this oil to keep the price per barrel low. Do you see that if oil does drop, would this be a good time to start to replenish that SPR? And you know what I'm thinking also, Francisco, is that now we're heading into the summer. Those who live on the Gulf Coast, we've got, which is Louisiana, Mississippi, Florida, and Texas. We're heading into hurricane season. Do we have enough oil in the SPR right now to be able to, in the event of a natural disaster?
We've really come down from a high point of 700 plus million barrels way back when, and then more recently 620 or so. So we've drawn down a lot of oil. I think we are getting dangerously low levels, but we are nowhere close to the minimum required levels domestically. Now, for international purposes, the U.S. also has agreements with the International Energy Agency and with the OECD, Organization for Economic Cooperation and Development countries, so essentially developed nations, that require the U.S. to keep 90 days of forward import coverage, meaning the U.S. has to keep 90 days of oil reserves in store in case something happens, there's some dislocation. The reality of the matter is the U.S. is a net exporter of energy today. The majority of U.S. production is not in the Gulf of Mexico. It's actually onshore. So if we were to lose some offshore production because of dislocations, there could be definitely some logistical issues, but I don't think it's a massive risk. I think the reason to refill the SPR is much more geopolitical in nature. Is what happens if we end up losing oil supplies, not in the U.S., because the U.S. has said is now a net exporter, just in the global economy. We end up losing oil supplies from a major oil producer somewhere else because there's a war, because there is an attack of some sort, or maybe there is a revolution. We saw it during the Arab Spring, right? So I think that's the reason to maybe refill the SPR, and I think the Biden administration has been clear they're looking to do that. Remember, they may not bring it back to the prior levels.
Francisco, when it comes to our refineries in the United States, we haven't had a refinery built, from what I understand, like since 1977. Well, that's just a couple of years short of a half a century. And refineries need at least annually to retool. They have to shut down because they have to replenish parts and just retool their refinery. And I would assume that the older the refinery, the more retooling there is needed. Do you ever see would you ever see a refinery ever being built in the United States again?
I think the answer, Andre, is a resounding no. We're not going to build more refineries in the U.S. Remember also that we are quickly transitioning away from thermal fuels, and one of the big changes that's going on is electric vehicle sales are picking up at a very fast pace in Europe, in Asia, and then increasingly in the U.S. as well. We sold 15 million cars, electric cars, last year, and that trend's going to continue. Now, the majority were sold in China, a lot were sold in Europe, but like I said, I think this is a global trend. Battery technology is getting better, and I think people are going to end up buying electric vehicles not so much because of subsidies, which, as you know, are part of the Inflation Reduction Act, but simply because over the course of the next 5 years, they're going to be a better product, just like we saw with Tesla. So I don't think we're looking to build a lot more refining capacity in the U.S.
Right now, the Biden administration is saying how they want to be able to be off of fossil fuels for automobiles. I think the year was 2035, but that's basically about, give or take, about 11, 12 years from now. Do you think that with the timeline that we would be able to be free of fossil fuels by just 12 years? And something else I'm thinking of, Francisco, is that to be able to charge the EV battery, you need a power grid. Well, to be able to create the power from the power grid, you have to have, whether that be natural gas or electricity, you have to have some type of energy source. Solar is only a very small part of that.
Are we going to be free of fossil fuels in 12 years? The answer is absolutely not. Now, are we going to be free of fossil fuels in certain parts of the world in 20, 25 years? The answer is absolutely yes, right? So now we don't have the ability to manage a power grid with batteries today, but I think over the course of the next 10 and 20 years, we'll see dramatic changes in technology where hopefully the U.S. and Europe will be leaders, because today, remember, the biggest driver, the biggest player in this market of electric batteries and solar power is actually China.
As head of commodities at Bank of America, one of the elements that's needed for the use of batteries for EV is such as lithium and other minerals as well, too. You were talking about China. Do we in the United States have enough minerals to create the amount of batteries we need without having a more dependency on China?
Yeah, there's definitely a scarcity of minerals. But I'm not going to sugarcoat it. It is a problem. And probably one of the biggest problems we face is having the metals for the energy transition.
Do you think with E&P companies today, exploration and production, with the restrictions that the administration is putting on for being able to, for permitting and restrictions with EPA and for the Department of Energy, it sometimes becomes very difficult to be able to drill before you even spud a well? Is it better for a larger oil company to, I'll say, quote, drill on Wall Street and buy the companies of smaller companies with proven reserves to replenish your oil supply?
The answer is absolutely yes. It's not a bad time to be buying each other out. To your point, you drill on Wall Street.
Francisco, I had a lot of fun. I hope you come back.
Thank you. Thank you for having me again.
Thank you, Francisco. Well, if you have a question or maybe a comment about the show, we'd love to hear from you. Make it concise, make it pithy, and write us. And notice the new email address at andre@benecapital.com. So let's take a look at the markets heading into next week. But first, what home improvement company on this day in 1979 opened their first 3 stores in Atlanta, Georgia? We've got the answer, and it's coming up. Well, what home improvement company on this day in 1979 opened their first 3 stores in Atlanta, Georgia? Home Depot. So, let's have a wrap up on Wall Street. 3M is agreeing and settling to pay between $10.5 and $12.5 billion in their class action suit from cities saying their drinking water was contaminated by 3M chemicals. Now, that's according to plaintiff attorneys. Math and reading for 13-year-olds have plunged again, and according to the National Center for Educational Statistics, for 13-year-old students, they dropped 9 points for reading and 4 points for math. That was a survey from 2020 to 2023. Well, these scores have declined since the last survey from 2012, with a reading down 7 points and math, that was down 14 points. Some of those math scores are at the lowest levels not seen since 1978. And according to U.S. Census Bureau, the median age of Americans is getting older. In 2000, the median age of adults was at 35. In 1985, it was 30. Well, today, due to population growth, a delay in having children, the median age of U.S. adults is now at 38. And that's a wrap-up on Wall Street Wrap-Up. And finally, can you name the most American car maker? Meaning, the American car maker that's made most in America. Well, here's a hint. The company has the top 4 spots on Cars.com on American Made Index, and 6 of the top 10 are not based in the United States. They are, from number 10, the Acura RDX, followed by the Honda Ridgeline, the Acura MDX, Honda's Odyssey, Volkswagen's ID4, and the Honda Passport. So, the most American car, is it a GM, is it a Ford, or maybe a Chrysler Jeep? Nope, but they're all made by Elon Musk. They are the Tesla Model S, the Model X, the Model 3, and the number 1 American-made car, according to Cars.com, is the Tesla Model Y. In fact, out of 388 total vehicles made, Tesla owns the top 4 spots on the list. Kind of makes you wonder just what's going on in Detroit, right? Well, the summer officially has started this week with vacations and travel plans being made. So join me next week when we talk with the former CEO and chairman of United Airlines, Oscar Munoz. Oscar is how will gas prices affect ticket cost, overcrowding. In fact, Oscar's written a new book called Turnaround Time, Challenges Facing CEOs, How to Deal with Them and How to Overcome Them. That's next week. Former CEO of United Airlines, Oscar Munoz. And that's our show for this Friday, June 23rd. Our thanks to Francisco Blanche with Bank of America for being with us tonight, but always we appreciate you for allowing us into your homes this evening. Have a fun weekend with the ones you love. I'll see you next week. Remember, if it's Friday, it's Wall Street Wrap Up. I'm Andre Laborde. Always remember, money never sleeps. Good night.
Wall Street Wrap-Up is supported by Bamboolas, featuring live music and coming soon, tapas and wine upstairs. Bamboolas, the heartbeat of Frenchman Street.